Yesterday's trading, selling off, produced a bearish left-right combo in the Dow, a doji followed by a bearish engulfing signal. That combination is one of the strongest reversal signals in the candlestick universe. Additionally, note that the selling closed the trading back below the T-line, producing an extremely high probability there was going to be selling the next day and making a likely target down here to the 50-day moving average, which would also be combined with filling this gap over here. The NASDAQ, as well as the S&P 500, traded lower slightly, but notice it was indecisive. However, it also did a bearish left-right combo after gapping down the previous day, telling us the bears are starting to take control. Today's doji provides a format for whether this was just a pullback and they're ready to take it back up, or whether they're continuing further down based upon how they open tomorrow. Remember the doji rule: the price or the trend will usually move in the direction of how they open after a doji. Note how a pattern like the classic pattern of Papa John's, the fry pan bottom followed by a J-hook pattern, continued to trade positive today even though the markets were trading lower, with the implication that the J-hook pattern should have another wave of this magnitude. Just the fact that you could recognize the fry pan bottom and the J-hook provides extra probabilities that this pattern will still continue, because that is what happens with a pattern. It's a buildup of investor sentiment over a much longer period of time without any consideration built into the pattern as far as what the overall market is doing on any particular day. The same scenario can be applied to our recommendation on microchip, MCHP. Notice the left-right combo, J-hook pattern setup, and it traded positive today after bouncing up off the T-line, making the prospects that if it trades positive tomorrow, you've got the J-hook pattern, wave 1, wave 2, going into wave 3. And you've got very simple parameters to tell you when this pattern is not going to be working, if it closed lower and closed back below the T-line. The J-hook pattern recommendation on BEST was also the result of the J-hook pattern analysis. Wave 1, wave 2, notice how they started buying out of this little wedge and back up above the T-line, producing a doji sandwich, making the prospect of coming all the way up here, wave 3, the same magnitude as wave 1. Once again, this all occurred on a day when the market was selling off pretty hard. But knowing that the probabilities were that the markets were going to sell off, look at the evening star signal in PYX. If it opened lower today, you wanted to start shorting. And we could also recognize what type of pattern, a bearish J-hook pattern, telling us that if they get down to this level and they breach that level, now we can look for a lot more downside. So having both long and short positions in the portfolio when the market is in a consolidation stage, you're able to identify which short positions are going to work the best, as well as which long positions are going to continue their uptrend. That'll be it. We'll see you in the chat rooms.